Hello guys, welcome back to another session. It's so good to have you all back here. So we're looking at the 15 practical questions with Iwelabi. So yeah, let's get right into it.
So the first question that we have is question 1. At what point is revenue recognized in a logistics company?
At what point
Is
is
revenue
revenue recognized in a logistic company?
Yes.
Interesting. Revenue is recognized when whatever you are told to deliver is delivered. For example, you run a logistic business and you have a client that says, Iwelabi, come and help me to deliver this TV set to Mr. A, right?
Yeah.
And then the client pay. I'll be a lot practical here. Let's say the client pays. Iwelabi, help me deliver this guy to this guy, and the next thing is the client pays immediately. When the client pays immediately, right? This is what happened. Client is paying. I do DRCR here.
Yeah.
Client is paying. The guy pays, let's say 1 million naira.
Wow.
Bank, you debit the guy 1 million naira, right?
Yeah.
Now the next question is, do I recognize revenue when you are meant to go and deliver that thing is maybe next month or next week? You are going to deliver next week. Then you should know that you cannot recognize 1 million naira revenue during this period, right?
Yeah.
Cannot recognize 1 million naira as your revenue during this period, but rather you should have something called contract liability GL, or some people call it deferred revenue. Now this deferred revenue will be based on what? On your account heads, in terms of your business account heads. So you have logistic business, delivery, so you call it delivery. Deferred, you can do something like deferred revenue delivery, in case you offer different kind of businesses.
Exactly.
Right? Deferred revenue transports, right? Or you call them contract liability this, contract liability that. Now you post the 1 million naira here, you credit it until when you go ahead and deliver the items you are meant to deliver. Once you deliver and then the client is happy, you recognize revenue. And you ask me, why do I have to wait till that time to recognize revenue? What if the client is not interested again in you delivering on their behalf?
Okay, so the second question we have is, can commission be declared as revenue instead of whole amount? That is, you quote 200,000 naira on your invoice, having subcontracted a job, and your commission on it is say 50k. Is it allowed to declare 50k as your revenue instead of the 200k?
I love this question.
Okay.
I love this question, and the reason why I love this question is because it has multiple variations of how we can look at it. Number one is that you can look at it as your own money is 50k.
Yeah.
That's your revenue.
Exactly.
We can look at it that way, one. And we can look at it as, okay, what is your kind of service or business offering? Yes, and that is it. Okay, now you quote 200k on your invoice. That technically means that your business model is built that way. That is your business model, and every other thing that you spend is probably cost of sales.
Yeah.
Every other thing can go to cost of sales depending on how the business model is built. But if it is just all this, like all the expenses that you incur, maybe you are a service rendering business, you should know that every other expenses that you incur is reimbursable expenses. If it is just reimbursables, then no, it doesn't make sense that way. But if it is that you have to do you have to incur cost in material and all of those things, and then at the end of the day the only money that gets to you is 50k, then that can fly. I don't know if I'm making sense.
Yes.
If you are doing it such that this is a product offering, right? And this product, let's use cake for example. That is the smartest example. From the cake and everything that you are doing, the only money that will get to you for baking the cake, maybe you already have a standard commission kind of a thing to say, for baking cake, this is the standard 50k. Trust me, if you recognize 200k as your revenue, that is your revenue. Why? Because that is you are offering the complete product, and the rest can easily fly to cost of sales.
Yeah, I think me.
But if it is just an ordinary, like the way he said it, that you subcontracted the work, then trust me, you can only just recognize 50k as your revenue. Because it is now looking like what you do is more or less like you are just a contractor, and you just get work and you subcontract it out, and that is it. Because if you allow you to recognize 200 as revenue, that means by the time the whole revenue we get, the other guy too will recognize 150 as revenue before. So it doesn't make any sense again. Then we are bloating the value of the whole transaction. You recognize 200, the other guy recognize 150. That is 350. Do you get the point? So if it is a cake kind of a thing or a product kind of a thing, and then the next thing is to get it done, you need to incur this cost and stuff like that, then fine. Even if the costs are standard cost, then fine. Still, in my opinion, right? Fine. But if it is just all these subcontracts, you get a gig. This is the total amount of the gig. You subcontract it out, and then the next thing is you say you are recognizing, except if you also do that gigs from time to time, and probably you do not have what it takes to get it done now, and you are the one issuing the invoice, then it makes sense. Because then
where I have a job from Total, so I got a contract from Total, right? And then the contract to Total, the contract is 1 million naira. Right, that is the invoice that is sent to Total. The VAT on that invoice is on the 1 million naira, right? The withholding tax that Total would deduct is on that 1 million naira. Now, in-house, I know that I don't really have the capacity to do that job. So what I do is I have a third party that I subcontract to. I feel like if I recognize
that's cost of sales. Okay. You just recognize your cost of sales.
Exactly, because I have to recognize 1 million in this case, not maybe the 200k that is my portion out of the 1 million.
Yeah.
Okay.
Yeah, that makes sense actually.
Implication and all of those things, because if you're recognizing just the 50k, then how to reconcile when there's time for audit, the invoice you're showing is different from what you have.
So that's why in that kind of a thing, right? Can you hear me?
Yeah, I can hear you.
That kind of a thing, when you separate your invoice to include reimbursables, and that is when it makes sense to say we cannot recognize the full amount as revenue.
So
but if that's not the case, then
the client knows that there's a portion on your invoice that says this is my own commission.
Exactly.
This is
that's the service that, and then you just I hope that solves that.
Yeah, very clear.
Yeah.
Okay, thank you. So the third question: a client made a transfer to hire an event hall, and the event is scheduled to hold in June 2024. But payment for the use of the hall is made in tranches. Initial deposits done immediately upon conclusion of the agreement, and thereafter, when should revenue be recognized, and what are the accounting entries to be made?
Okay, very brilliant question. It's still this guy that we are going to use. So now you have made a payment of 500k. The moment that you are getting the money and you know that revenue, you know that the work is going to be done in months to come, then it is very simple. You
Wait,
know
Iwelabi,
clearly that you have not.
let's
Yeah.
make the scenario very practical. So let's say the event all is 500k. So let's say they paid 200,000 in January upon signing of the agreement. In March they paid
Okay.
100,000. In April they paid 100,000. In May they pay 100,000, which is the entire 500,000. But the event is in June. So how do you the accounting entries for each of these payments? I think that's what the person needs. Let's just use that scenario.
It's fine. So you pay 200,000 or 200,000 first. See, the accounting entry is the same
Okay.
from beginning till end. So what do I mean? As long as they are still paying in tranches, the accounting entry is going to be debit your bank, credit your contract liability, as long as they are still paying in tranches and you have not rendered the service. But now, let me say for bookkeeping purpose, so that it can make sense, for bookkeeping purpose and for the purpose of, let's say, sales bookings, how does it even make sense? You come here, you say Iwelabi, let's say date. What is today's date? Today is 23 Jan 2024. Then the next thing is Iwelabi paid back. You put Iwelabi's name. What did he pay for? Event or how much? So look at this thing: date, name, customer name, then products, then contract value, or you can call it amounts. So you go, how much is it? 500k. You can recognize this guy here. That's the contract value. Amount paid. You put amount paid. What's the amount paid? 200k. Then you put if there is a VAT element, let's assume that VAT. Okay, let's say this is the contract value. Let's assume that VAT is what's it called? This guy divided by 107.5%. 107.5. No. That's when we have removed the VAT. I'm just trying to get a walk back.
Okay.
Just give me a sec. So VAT is this guy minus this guy. I'm coming. Just give me a sec. So where am I going? Okay. So I think let's just do 7.5%. Yeah, VAT is this guy multiplied by this guy. So this is VAT, then this is total amount payable. Then this is balance, this guy minus this guy. So yeah, you see this scenario, right? What I just did here is a simple bookkeeping, record keeping for your use. So in case now in this month that the whole thing happened, right, you can easily say this is the sales that was closed this month, 500k. Why am I not saying 537,500? Because the VAT is not your money. The VAT is not your money, and you know that the entry for the VAT will not affect your revenue, right?
Yeah.
So the entry for the VAT is not affecting your revenue. Bank and VAT payable. And when you pay, bank and VAT payable.
Yeah.
So VAT is not your money. So the money that you track for your business to call revenue, or not revenue in this instance, but call your sales bookings or contract value, right, is your 500k. Now the next thing is you have amount paid. They've paid 200,000 naira. If you want to record this in your accounting entry, it is still debit 200,000 naira to bank, credit 200,000 naira to contract liability. Why? Because you are yet to deliver on the product. The next month they come and pay again, then trust me, the next thing you want to do is to probably have another sheet for balance payment, right? Or when they make some sort of balance payment, you want to have, let's say, balance payments. Like this is usually meant to be another sheet entirely, really. Let me show you what we do. So we can do we can do this guy and say dates, customer, what else, balance payable, balance page. That balance page can be balance page. This is how you design your spreadsheet. Normal balance page can be January, if it's coming from last year, Feb, I don't know, Jan, Feb, let me just to June. Then the next thing is it's Iwelabi here, so all this one can just be like this, and then you can just go up. I hope I'm not wasting so much time. Yeah, right now technically we can just bring Iwelabi's details here, like okay, we can just bring Iwelabi details here and say this is it. Then balance payable is this guy, what is the balance payable? This guy, put it here. Then we can normally, I think I will have put a date. Even in January I will have put the dates. So if I want to do, I don't just want to complicate it, but yeah, I will have put the dates somewhere here. So let me do February. If I do start from February, I can do this guy. Let me complicate this thing, but I'll just do dates, amounts, right? So yeah, I do. So a number of times we just build this template to just be able to like help the processes, and as much as possible you try to automate a number of a lot of the part of those things. So when did he pay in February? He paid on the 2/2/2024. We put it there. How much did they pay? 100k. He paid 100k. So he paid 100k. Then from there we know that there is a balance here that says this guy minus sum of this guy to this guy. I'll just use it as an example like that, right, to save us the time. Let's say the guy paid 100k, so it reduces. So each month that the guy is paying, you are coming to put it here, right? Once you are putting it here, you ask me what is the accounting entry. The accounting entry is still this guy. Debit this, bank, credit what? Credit your deferred revenue or current contract liability, and that's it. Does that make sense?
Yeah, it does. Okay.
Cool.
Thank you. So let's move to the next question quickly. So the fourth question that we have, again, how is refundable deposit received along with an inflow treatment? After transfer of service between parties, what is the accounting treatment? So I think what this person is saying that when you receive a deposit that has a portion that is to be refunded after the service is completed, how do you treat it?
That will have always been in, say, you will have always made provision for that one. It will be in liability. So you know that there is a portion that you need to refund. Then of course you don't recognize that as part of your full revenue, because you are going to still refund it. So something like accounting treatment would be like accounting treatment would be like when you receive the full money, you receive from bank, you receive 150k, you are returning 50k. probably you have not yet rendered the service, you have contract liability. The reason why you know that from the question, the reason why you are returning a part is because you have not rendered the service. Otherwise, you will not have to be returning any part. Why do I have to pay you more when I know that you are going to return parts? So if it is just an exchange of goods and services, there will be no need for more. Am I making sense? So the next thing is you have contract liability. We recognize all the 150 as contract liability. It is clear. When the when the service is rendered, we have revenue. When the service is rendered, we have contract liability. Let me use contract liability. We have contract liability. We debit the guy, because now we are clearing the contract liability account. What do I mean? Why are we debiting contract liability? Because now we want to recognize the revenue. So when you are recognizing revenue, you need to reduce your contract liability or deferred revenue account. To reduce that, you have to post a debit into that account. Why? Because it's a liability account in the first place, right? So we do debit contract liability, then revenue. We know that our revenue is 100k, right? And then we know that we are going to return the other guy 50k. Then the next thing is bank. We return the other guy 50k. This minus this. But let's say that we are not going to return the other guy's 50k right now. That means that we are only going to be concerned with recognizing our revenue. That will be or. So if I say or, that will be saying that debit contract liability 100k, then crediting revenue 100k. You know that the balance of the 50k will be found in your contract liability, so it will always be there till you get it paid, till you pay back.
I have a question. First
Please
of
go
all,
ahead.
I feel like this kind of method would have been good if you have like just very scanty transactions. But imagine I run like an hotel business, I run an event hall, and I have like hundreds of clients, and I'm posting everything, all the money I receive, even though I know there's a portion that is refundable. I'm posting everything to contract liability. There will be a lot of mess going on in my contract liability GL. And
So that's why you are not going to post every day.
So I was thinking, see, left to me, I would have said debit bank with 150k, credit contract liability with 100k, credit a liability, let's say refund GL with 50k.
Yeah, so that's also a very that's also like a very brilliant one, right? Because you know that there will always be that refund. So that way, that in fact, I will agree with you because excuse me. Because with that is a lot straight, like that is fast straight. So I'll definitely agree to that, to say, okay, in that case, if that is the way, I say then we have a refunds GL, refunds. So which, this refunds GL, or let's say, don't let me call it refunds, I call it customer wallets. Customer wallets. So you see this customer wallet continues to take charge of customer. Let me just put the 50k here. Then I change this guy to 100k. Yeah. So in all honesty, I feel like this makes a lot more sense, right? This makes a lot more sense because at the end of the day, right, with this, you are able to like identify the list of the customers a lot easier, right? Like it's yeah, thank you very much for that. I think this makes sense, right? This makes sense. So yeah, this is like the best way to go about it when it comes to accounting treatment for it. You can always have that customer wallet. But let's say in the event that you don't know how much you are going to be returning, right? Maybe you are giving a warranty or stuff like that, you don't know how much you are going to be refunding, then we refer to IAS 37 on provisions. So this usually you do at the end of the year, where you make provisions for based on the likelihood of events of people that are going to come back to request for their refunds, right, from previous trends and stuff like that. Then you do your calculations, you run your numbers, and yeah, I don't know if that makes sense.
Yeah, it does.
But yeah, this is a very cool one. An alternative way that I will have used will have been that, because I know for sure, like for me, when it comes to revenue recognition, this is usually the number one. This is usually like the best approach. Bookkeeping first, like proper bookkeeping first before posting. Posting will usually happen at the end of the month into the system. So I know the total revenue, I know the total this, I know the total that. At the end of the month, I post them in the system, and then I post whatever that is left, and then we use this particular sheet to track everything that we need to track. It might look like, why are you doing double work? But no, it won't be double work, because I will post a single time, and at the end of the day, if anybody is asking for my source document, I send this guy to them, because GL will most likely not support me as my source document in the first instance, because the guy just wants to take your GL, and then this is the way you approach, or this is the way I approach working on financial transactions and building my financial control, finance function, right? I build my finance function on the premise that one day I will get to be audited, right? So since I know that I will be audited one day, and given my experience working as an external auditor in the past and an internal auditor as well, right? I can easily predict what controls I need to put in place to ensure that my audit is always smooth. During my last firm, PwC was my auditor, and I'm very, very proud to say I'm one of those people that makes the life of my auditor easier, except for when we need to have talks on complex accounting matters and make decisions, right? But yeah, in terms of providing schedules, providing support, I feel like I've been able to like excel in that part, because you always see my support documents, because I'm very, very big on these things, right? Thank you very much, Claire.
Ifrs 15 year, we're learning a lot of things about real life issues. Actually, I've picked more
moving on.
Ifrs 15. Okay, so let me go to the next question. Question 5. A law firm enters into a multi-year contract with a client for various legal services, including litigation representation, contract negotiation, and ongoing advisory. The contract involves fixed fees for certain services, hourly rates for others, and a contingent fee arrangement based on the successful resolution of a significant regulatory case. My question arises from determining when the law firm should recognize revenue under Ifrs 15. I hope I was not rapping. Did you get the question?
No. I can, I hear you, and I can I can access it. Okay. So I hear you. First thing first, I love these questions because it is all encompassing. Right, it is all encompassing, and there are different kind of fees and stuff like that. What this person needs to know is the position of Ifrs 15 is not going to change, regardless of how complex the transaction is made. What you need to do is to still break down the transactions into their individual pieces. What do I mean individual pieces? Identify the performance obligations in each of the transactions. No story. And then let's take it first. You said the contract involves fixed fees for certain services. Those ones, no story. Let's say, for example, the legal services, you're on a retainer, right? That is the one that has fixed fee. Retainership will usually involves amortization, because except for the ways you are being paid, if you are being paid annually, quarterly, or however, maybe monthly may not likely involves what's it called, amortization. But if you are being paid annually, then you need to amortize for a retainer. So what do you do for a retainer? Say for retainer, you are being paid. I'm coming.
Okay.
For retainer, you are being paid 1 million naira now. 1 million naira for retainer, right? When you are being paid 1 million naira for retainer, and you know that it's going to be for a 1 year period, if you get your money in January, you should know that if you get your money in January, you are going to have to amortize this thing over a 1 year period. And how does this even make any sense? How does this even make any sense? I say, look at me. you have gotten retainer. This is how we usually go about it. You have gotten retainer. You say you get retainer on the same date from the same person. Legal retainership. Or let's say retainer, yeah, then 1 million naira. That's the contract, right? Then every other thing, let's say the 1 million naira, every other thing, right? Then amount paid is let me say amount paid is this guy, right? Then this guy is 0, so they've paid in full. You see, you have recorded that the contract value is 1 million. The amount paid is this and everything. So this is the first record. The second record is to come here. This is where the deferred revenue usually is. Deferred, we call it revenue amortization table, or revenue amortization, or deferred revenue amortization. So this is where the first sales part is. This is the sales part, then this is the amortization part. What do? I say January, February, I continue that way up until I'm done here. So let me reduce this guy a bit. Yeah, I want to be seeing everything up until I'm done here, right? Then the next thing is we can always bring the total sales. What is the total sales based on litigation? We can first have sales based on litigation, sales, right? So let's say sales litigation. This is the contract plan, right? Then sales event, or no, don't let me use event, or let me just use event, or let's use different kind of thing. Then this is the sales. So I come here, I say these are the sales that was gotten in January. Sum of these are the sales that was gotten in January. I link them to say, oh, okay, there are different sales. So let me separate them now. Okay. I'll separate them. So this is the sales, this is this. Then the next thing is I come and say, let me recognize revenue from it. This is revenue. So I do the same thing. Copy this. I go this way. Then I say revenue bar. Copy the same thing. This is this. Then revenue is, I know that the guy has paid for 12 months, right? Divided by 12. Then I drag up to this place. Sorry, I didn't what's it called? I didn't lock it. So let me just lock. Let me lock. So I say this guy is this guy. Then I say event, or the guy is due in June divided by 6. Right. Oh, we have not rendered the service, so I will not recognize revenue for event or, because it was still in June. Then we have deferred revenue. Then the next thing is, since we have deferred revenue, we come again. Let me just equate this thing. We come again. Then we do this guy minus this guy. That's the deferred revenue on this one, and this one is equals to this guy minus this guy. That's the deferred revenue on this one. At the end of the day, by the time I'm going to post into the system, I'll debit my bank, I'll debit my bank. Now the posting is, look at this posting. The posting is, I'll do this, debit my bank, because this is the total amount that the guy paid. I can come and pick it from this guy that it has paid from. Right? Bank. I'm removing VAT payable because I'll just like net of VAT basically. Or let's have both with VAT. This is the amount paid with VAT. So I put this guy bank, then I'll credit revenue. How much is my revenue? This is my revenue on this thing. right? I'll credit contract liability or deferred revenue. This is this guy, that's this guy here. Then I'll do VAT payable. That is this guy here. Then the next thing, I do my check. Oh, okay, they are both correct. So this is what I'm posting into the system. In sales record, being revenue recognition for the month of January. Litigation. No, just this guy, and then I'm done. So you ask me what of the next month? I say the next month is that for deferred revenue part of the next month. This is where deferred revenue is. You get it's funny. This is where deferred revenue is today. Tomorrow, I've already have this guy here. This guy is already here. Then I say equal to this guy minus this guy.
That shows the balance.
So it continues to, like, each month I continue to do that to get the balance.
Wow.
Right? And this is how I manage that guy. So I do this based on the different revenue streams that I have. Right? Based on the different revenue streams that I have, based on the different modes of let's say payment terms that I have. So people pay annually, people pay quarterly. I do this based on that. So by the time I'm done with this guy, trust me, my life will be a lot easier, a whole lot. Because each month I can just drag this and say this guy, because this guy will definitely just minus this guy. And let's now say there are other ones too. You see, this guy will continue to be zero. This guy will continue to be zero because there is no revenue to be recognized. It will continue to be zero until when it is June for me to recognize my revenue when I deliver the service.
Wow.
Yes. So, very lovely question from this person, right? So you say you have different forms of you break them down into this. So the ones that have fixed fees, right? You know, is this once you are rendering the service like retainer, for example, you see that we have split retainer. So this is how you recognize the revenue for retainer. Then let's say for advisory, based on whatever you are advising them on, if you charge them immediately, you get your fee for that one. Because usually for advisory, you will have rendered the service. In fact, you will have had to record receivable first. You will have had to record receivable where you have rendered the service and then you are billing them after. Right. So in that case of you billing them after service, you know that you have your debit and credit again.
Okay.
Let's say you are billing them for 50k.
Enjoyed the tutorial. So sorry to interrupt. I just wanted to plead with you, Biko, Ejo. I just wanted to plead with you to say that you should please subscribe to our YouTube channel. Subscribe, like, comment, share. These are things that motivate us to do more, and then they are absolutely free for you to do that. The truth is, a lot of effort that go into creating this video, editing it, uploading it, and all of that. All of this was saying that the only way for you to say thank you is just by hitting the subscribe button, liking the video, and commenting. I think that is a fair deal, right? Alright, so please, I'm waiting. Go ahead and comment, go ahead and like, go ahead and subscribe. I'm waiting. Okay, thank you. Let's get right into the tutorial.
Right, and you do that will now be receivable and then revenue. Why? Because you have rendered the service, you are just going to collect your money. So in that instance, for example, that will be you won't have deferred revenue because you will have earned the revenue right from here for the advisory that you rendered. So let's now say the ones that are hourly rate as well. Those ones are even very straightforward because it's hourly. So you have rendered the service, you've known the hours that you've used in that service. Then you recognize revenue based on whatever you are charging for that. The most interesting part is the contingent fee, right? This is very interesting because when it comes to contingent fee, you cannot recognize revenue, right? You can't recognize revenue because it's a contingent fee. You can only recognize contingent assets, right? In terms of you make provision for your assets, right? But before you even recognize provision for your assets, what do we call it? You create provision, contingent liability, contingent asset. Okay, so before you even recognize your assets, before you make provisions for your assets, it has to be certain. According to IAS 37, it has to be certain that you are going to win. It's not whether it is probable. There is no probable when you are the one that have to recognize assets or revenue. You cannot recognize revenue on this kind of a thing unless. So if you are going to court, you see this part that says that a contingent fee arrangement based on the successful resolution of a significant regulatory case. You see that part? The way it works is usually they will have billed you separately. Now they will have billed you separately to recognize revenue for certain things. Maybe each time they go to court, you pay this amount. Then if they are not going to be contingent fee on a case that they are working on for you, they cannot recognize revenue on that one until that case is won. They cannot even recognize. They cannot make provision for assets until that case, unless they are certain that they are going to win the case. 100% certainty. That is what IAS 37 requires when it comes to recognizing assets, like contingent assets. That is what IAS 37 requires. 100%. So in this case, this is like the most this is very tricky, and it's straightforward at the same time, because unless you just want to be doing yourself like this, it's straightforward. Unless you are sure that you are going to win, not even going to recognize revenue, but you are going to recognize contingent assets instead. Until when you win, then you debit the asset, you credit the asset to take it away from assets, and then debit what's it called? Okay, let me use accounting. Let me use numbers to play. Let me play with numbers. When you win, right? Let's say you've recognized assets before now. You take it away from assets. Let's say PP, contingent asset, right? Contingent assets is 500k. So initially you have done this. Debit this. I'm coming. Let me see my thought process. So initially, when you do your, in fact, let me see. In fact, if you are going to do this, you are probably going to be having the contract liability as well, and it's actually funny because even if you are doing this, if you are debiting your contingent asset, you cannot credit your revenue, because it is not yet a revenue, right? So the most place you can debit is contract liability, and then it will be funny because you are recognizing contract liability when you actually do not have a liability in that regard, except that you are also providing a liability. So it's actually going to be a tricky one to even recognize revenue in that instance, right? It will be very, very tricky to recognize revenue because you really have your contingent asset to debit. When you debit that guy, then the next question is, where do we credit? You can't credit provision because it doesn't just make any sense. And you can't credit contract liability because maybe that is the closest, because you are already in that agreement. You have you have that responsibility to fulfill an obligation for them, right? So it's actually a tricky one, right? So even if you are crediting contract liability, the next thing will be by the time. So the reason why we are crediting contract liabilities as well is just to nail out the asset that you have also created, right? So because on a normal day, it's supposed to have been from contract assets to an income kind of a thing. But in this case, it is revenue we are talking about. It will not be a revenue for you unless you have rendered the service.
Yeah, true.
So that's like the last part of that question, and I think is really tricky because people can just go ahead and wake up and recognize revenue. You can't recognize revenue because now we are having two standards that we need to use to address a certain issue. So IS 17 is there because this is related to IS 17. And if you notice something here too, I said something about whether you give a warranty in terms of returns or refunds is also part of what. See, warranty is also treated on what's it called, IS 37. So before refunds and all of those things can easily happen, you see customer refunds and all of those things. A provision if the entities are established policies to give refunds. Past event is the sale of products. At time purchase, that a refund will be available and stuff like that. So there are things that some of these standards work hand in hand, and you have to just ensure that you kind of have a good understanding. You increase your breadth of your understanding of the standards, right? Because a number of the standards, you have to use them together. Like this now, right? Anybody that doesn't really understand IS 37 will probably have thought you can recognize revenue based on if you can calculate the contingency fee and stuff like that, maybe you can recognize revenue. But no, you can't unless you are certain that you are going to win. If you are going to lose, then no story. If you are not even so sure, then no story still. Yeah, moving on. I think we need to move faster now, probably so that we can.
That's what you keep saying every time.
Yeah, now we need to move faster.
Okay. All right. Question 6. This is quite straightforward. How do we recognize the income of a company that does supply of furniture?
When the furniture is supplied. Yeah, thank you.
All right. Question 7. How do telecommunications company recognize their revenue from airtime and data?
This is a very interesting question. I remember during the one of the town halls on Ifrs town halls that's usually hosted by some of my big guys in the industry, right? So this particular one almost caused drama, right? It almost caused drama. Yeah, because it's actually tricky. And eventually we all agreed to Idris Ayinde's opinion, which is something that I've always the opinions I've always held in mind around the subject matter. Why is because when it comes to airtime recognition, say an MTN for example, if MTN sells airtime to you, if you buy airtime from MTN is not going to recognize revenue on that airtime until you use the airtime. That does it.
Yeah.
They will not. Now, somebody else now ask, what if I buy for the purpose of reselling? Then that makes sense. Once MTN sells to you, then you start reselling. MTN can recognize revenue in that regard. Because MTN has fulfilled the obligations that they have to you. And that's why all those SME data and all of those things, once those data are being sold, then you can recognize revenue.
Okay.
It's actually a very tricky stuff and requires a lot of, understanding of the subject matter. Another part of the thing is that, okay, what if buy this amount of data, get this amount of airtime, they are bundling stuff together. Then you have to use the step, what's it called, 4 of the IFRS 15 5-step model, which says you have to allocate the transaction price to a performance obligation or to each performance obligations. So you have to do all of those things. So in terms of recognizing revenue, they recognize revenue when you use the data. That is, when you buy directly from them, they have to recognize revenue only when you use those things. When you don't use yet, they can't recognize revenue yet.
I think it makes sense. It makes sense actually. It makes perfect. The question 8. Can an interest received on an investment be regarded as revenue?
No, that's the simple answer. No, except if you are an investment company. So no, because you have said it's an interest received on an investment. It's an other income. Okay. Right? It's an other income. It's not a revenue. Revenue is mainly on your primary source of income in terms of your cost of business. Right, okay. What you are actually established to do. The money that are arising from those ones are the ones that I recognize as revenue. Any other ones are other income.
All right. So, question 9. Thank you for this great opportunity. Please, when is revenue recognized in construction company? How are the advances before completion treated in the ledger? Why is accrued income not recognized by IFRS 15 as revenue in the financial statement? Kindly tutor us on every aspect of revenue and their treatment in the construction industry.
Yeah, I think we'll just have to use this to circle back to the input and output revenue recognition method, right? Because so number one thing is the money that you received, most especially before you render a service, will usually go to your contract liabilities.
Yeah.
Right. That's it. The money that you received, most especially before. So now the next question is, how do we then recognize revenue? Right? How do we recognize revenue? You recognize revenue in one of two ways, yeah, which is what I've kind of tried to explain here. You recognize revenue in one of two ways. One way is that you recognize, so it's a construction, it's even the perfect example for what we have been talking about. It's a construction company. You recognize revenue based on output of work that you have delivered. You know, so if a work is going to take 6 months, and then it's going to take 6 months, and you know you have your timeline of where work should, what and what needs to be done before the work can be considered completed, right? And then you know as well, right, where each stage of work, you know what can be said to have been done in terms of the value. So, and that's where the service of evaluator is always, external valuer or evaluators are required, right? Where you come and issue certificate of work completed so far, right? So that they can tell you this is the total amount of work that has been completed. Maybe they've rated it at 65%, they've rated it at 70%. Then you recognize revenue based on that, right? Then the other part is based on the amount that you have spent on the project. That's like the input method. So usually it can be something like you can record something that you can see like a cost of sales kind of a thing.
Okay.
Right. These are input methods such that you recognize revenue based on the amount that you have spent on the project till date. So those are like the two methods for which you can recognize revenue. A lot of things can happen in between, right? That requires different treatments, right? Most especially the one that Peps was trying to mention the other time around when let me remember, I think it's receivable, it's related to contract assets. Yeah, contract assets, right? When you have probably expect money to do some part of these things, and then you are expecting certain amounts from what's it called, you know, from your clients and stuff like that. Yeah. So again, in terms of accrued income is where contract liability comes in. Actually, what you will have called accrued income is sometimes, though it's quite funny, because sometimes accrued income, people refer to accrued income as income of service that you've rendered that you have not yet collected. In fact, that is like the meaning of accrued income. Deferred income. Accrued income is more or less like money that it's more or less like receivable. Now, maybe not necessarily receivable, but the simple definition is money of work that you have done, but you are yet to receive it. Those ones you have earned the revenue. They are revenue that have been earned, and I think in terms of why is it not recognized in the financial statement, it's already recognized. It's just semantics, or is it semantics or just what do we call them now? Nomenclatures, right? Now, because that's your revenue. Many times you are accrued, but now because we might always be differentiating income from revenue, but these are also still nomenclatures issue, right? Because at the end of the day, there are times where people use revenue instead of income. You know, they use revenue they use income in lieu of revenue rather, and they use them interchangeably, right? So IFRS 15 recognizes accrued income, because I want to assume that is because you are talking from a construction contract part. That is where revenue actually comes in. That is what you're talking about. It's revenue that you're likely going to talk about, because so revenue that is as accrued. Say you have rendered the service you have done this part, but you have not gotten your money. That is where you say accrued income. So yeah, any other style? Another style might be in terms of what do I recognize as revenue? It's a construction contract. You recognize your own contract, right? Once, as long as you are doing your job and all of those things. Every other things are cost of sale. Unless when you are an agent, then you recognize your commission. You cannot recognize all the things. When you are an agent is when you recognize your commission, but other than that, you recognize all the contract as your revenue. I love the next. The next question, please.
All right, thank you. Okay, the next question. I think that you've really spoken about this before. How do real estate companies recognize their revenue?
Real estate recognize their revenue when the service has the estate is ready,
and they sell it.
And it's similar to construction contract, right? When it comes to selling, that is very funny. So estate is ready and you have to sell. In fact, for real estate company that's into selling, right? Like you have to sell before you can recognize revenue.
Yeah, exactly.
Because every other thing is still like your inventory kind of a thing, IAS 40. Right. So the other ones, you have to what's it called? You have to sell. But real estate is of different they do different things, right? Some people build for people. So people that build for people, they are already going to recognize revenue when they deliver on the projects.
Exactly.
Do you get? And some people do rents. So you recognize revenue in terms of rent when people are using your house, right? And that one, most cases, you have to do amortization since it is going to be for over a period of time, right? So any other thing in respect of, and then in real estate, you cannot recognize all your, most especially when you are the one that is like a broker and all of those things, you can't recognize all the amount as revenue. Most especially when you are a broker that you are just getting commission out of the whole thing, right? So you can't recognize the all amount as revenue if you are just getting commission. Just take your commission, that's the revenue. You move on.
Okay. Yeah. Thank you. Question 11. You worked with a construction company that borrowed loan throughout last year to execute all the contracts they got. I don't know what to recognize as revenue in my financial statement. Is it the loan amount borrowed to do the work or the contract amount awarded?
It's quite simple. You need to first recognize which of them is the what's it called now? Which of them is the price? Which of them is the price, standalone price, according to Ifrs 15? That's the third item, right? Which of them is the standalone price? You need to know what your standalone price is. Standalone price will usually be your contract amount. What is the amount of the contract awarded? That is usually what will constitute your revenue. Loan will not constitute your revenue in any manner. Exactly. In no manner should you take loan as revenue. The fact that you borrow to get the job done does not necessarily mean that is the what's it called? That is your revenue.
No, at all.
Exactly. Revenue is the amount that was awarded. So the part where you borrow loan and all of those things, you can then recognize revenue in stages like every other construction businesses. Whether through input or output, right? You can do that. But you should not be on the basis of the loan amount that you borrowed. Loan, you definitely just eat your bank account, eat your loan account. Exactly. And that's it.
Just a source of financing.
Exactly. That is the right phrase, right? Source of finance. Loan is just a source of finance. For revenue, it is on the contract amount awarded. That is your revenue. I hope that answers that.
And that is based on the percentage of completion.
Yeah. So until you are done, in fact, if left to me, I'll say on many of these questions, in order to avoid misunderstanding, complete revenue recognition or total revenue recognition only happens when you have delivered on this project, right? But because of IFRS 15, right, there are phases of revenue that you can recognize for long-term projects like that, and it is based on percentage of completion of work done or based on the input that you have put into the project, right? So, yeah, that's that on that.
Thank you very much.
We have very few, less than 5 minutes to go, please.
Less than 3 minutes. Okay.
Yeah,
So
yeah.
you worked with the okay. How does a loan company recognize revenue?
A loan company recognize revenue once they issue out the loan. Regardless, once you issue out the loan, you recognize your revenue. Now you ask me, what is your loan? What is the amount that you recognize as revenue? It can either be your loan, entirely loan amount. No, loan amount is not even like what you recognize as revenue, but your interest. Yeah, the interest on the loan is what you recognize as your revenue. It's going to see whether your loan amount is paid. So depends on the length of the length of the loan, right? If it is a loan of a long term, then you have to amortize over the period of which the loan comes. But the cool thing about this thing is that many people actually give out loan out on month basis in terms of percentage of interest that they are receiving. So if it is that, then it is easy for you to recognize your income or revenue on a monthly basis. But if it is one that you do annually, then you have to amortize it by yourself.
Yeah,
right.
Definitely.
So let's say you are giving 30% annual per annum. You give out the loan in February. You have to do 30% of that interest of that amount, and then divide it by 12 to get your monthly amortization.
Right. That's really clear.
But here is where I was going to go to before when I said probably you recognize the old loan amount, which is not the case. Where I was going to go to is that in the case or in the event that you also have a cost that you incur, probably you also source the money from someone, then that means that your interest will also have a cost of sales, which is the interest you are going to be paying to the finance providers. Right. So in that case, you also have a cost of sales. Otherwise, you probably might not have a cost of sales. I hope that answers your question.
Yeah, it does. Let's run question 13. Please, how can one recognize revenue of an entity generally? Please skip that question.
I love this question.
I was going to say we've answered it now. Come on.
Exactly. We've actually answered it, but I love the fact that the person asked.
Yeah.
Deliberate.
Yeah.
When you ask this kind of questions, you have a comprehensive knowledge of how things work, basically. So, how do you recognize the revenue of a business generally? Just follow the concept of Ifrs 15 and take note of performance obligation exchange. Just take note of that. Just simplify it. What is the performance obligation? What has the performance obligation been met or satisfied, and how much is involved? That's all. Every other thing, just forget it. I hope that answers your question.
Yes, it does. Question 14. What is the revenue recognition criteria for a labor outsource enterprise? I think that's still.
When you say labor outsource enterprise, it's kind of maybe let's say a company that your commission on whatever labor that you outsource.
Exactly, that's your revenue, your service charge, your management fee.
Yeah, exactly. And it happens once you give the labor. Once you facilitate the process of the labor going to do whatever they want to do, you are out. Yeah. As long as there is no caveat of refunds based on one thing. Other than that, once you deliver on your part of the bargain, you are good to recognize revenue.
Thank you. The last question. How does a consulting firm like auditing firm recognizes revenue? We flogged this before. We've spoken about it.
Yeah, we actually mentioned it.
We have,
but it's quite straightforward as well. Follow the performance obligation, right? Just follow the performance obligation. They basically recognize. So the good thing about auditing firm and all of those things is they are service based. So just know when the service is rendered. So once the service is rendered, you recognize revenue. So if it is service that is going to be rendered for a long period of time, you recognize revenue over the period of time that which the service is going to be rendered. Other than that, you are good to go to recognize your revenue once a service is rendered. I hope this answers your question.
Yeah, it does. I've been overfed by Ifrs 15 right now. I feel like I'm very. Come on, ask me any question on Ifrs 15. I'm good. Thank you so much. Thank you so much for your time. I honestly cannot thank you enough. We are all grateful. On behalf of everybody that will be watching this tutorial, we're saying thank you so much. God bless you. Thank you so much. We sincerely appreciate. Thank you.
You're
Do you
welcome.
have anything
Thank
you
you
want to
very
say? Do you have a closing
much.
word for us?
Well, if there's any closing remark, what I would just say is that accounting and finance is actually a very, very interesting industry. It's
Hmm.
like a superpower, if you ask me,
Hmm.
because you just typically knows everything that is happening around every part of the business organization,
Yeah.
right? And then the best way, or one of the best way to improve your skills around technical skills in terms of knowing about revenue recognition and all of these things is just to, you can do mental practices. Just assume different businesses and try to think of how do you think these people do their things, and then
Hmm.
when you attend them and you are not so sure of your response, then reach out to experts, people who are your senior colleagues or your colleagues, request for opinions, and then you have to try things out a lot. People say Kudus or Iwelabi, how come you are so good with accounting? In fact, people has literally approached me to be like, how come you are just so good with accounting
Hmm.
and finance and stuff? I say, what? I do a lot of practice. I've worked in multiple industries: real
Hmm.
estate, business, FMCG, financial services, education technology, consulting, accountancy services, like or like hotels,
Hmm.
restaurants. Like, I've worked in multiple industries, and I've done simulations as well of different industries on how they are going to be recognized through their revenue and how their finance operations should look like, right? So doing all of these things actually help you. You do not need to wait for you to get all those big opportunities before you
Hmm.
understand how these things work. You can leverage your current situation or your current position to learn and know everything you want to know one way or the other, and then ask questions. Like, ask a lot of questions, because in recent time I've continued to mention, or I've continued to opine, that the difference between those professionals that are still coming up and the expert is the quality of their questions.
Hmm.
Go and watch out the experts, the level of the way they ask questions. You will just be amazed, because knowing how to ask the right questions facilitates the best results,
Hmm.
right? It gives you the best result, and that's like what I'm going to leave us with.
Thank
Thank you
you.
very much, guys, for
Thank
having
you
me.
so
It's really a
much.
privilege to be here as well. Thanks a lot, Peps.
Thank
Thanks
you
a
so
lot. I really.
much. Thank you. I'm coming
Mm.
to your DM after this. Enjoy and
It's
have a
fine.
great evening away ahead. What am I
Yeah,
saying?
bye.
Ah, Onga. Thank you. Take care. All right.
Yeah,
Bye.
bye.
Okay.
Bye. Yeah.